We are live.
I think we are live.
Excellent. Welcome everyone tuning in. Thank you for letting us all know where you're joining us from.
Yes, we still have quite a few attendees coming in, so do say hi and say where you're dialing in from. It's great to see people from all over the UK. Oh, Putsborough, one of my favorite beaches. Hi, Bill from Putsborough, and people dialing in from Spain, the Isle of Man, Cornwall. Fantastic. I'm tuning in from Oxfordshire.
Fuerteventura. Wow, pretty jealous of some of these locations.
Well, I think we can probably crack on because we'll just be going through the intro. So we think this will be about a 1-hour webinar, hopefully a little bit less, and we'll open it up to Q&A at the end. And this is on a very hot topic, which is when to sell, which actually is always the number one question that people ask us in surveys at the end of webinars and in feedback generally. So this is a very broad brush view of the subject. And Megan and I, putting the materials together, sort of realized we could probably do about 5 webinars on this topic. So there'll be a lot packed in and we won't cover everything, but it should be fun.
So yeah, get your questions in. We've got Alex Lamani with us in the background, so he can help field some of your questions. He's one of our analysts here at Stockopedia. So he'll be able to help any technical questions that you have. Yeah, and hopefully, as Ed says, we'll be able to cover as much as we can about this relatively large topic in the hour that we've got.
Yeah, quick disclaimer, this is very much for educational purposes and this will not be investment advice. We will be sharing quite a lot of information on shares and on some of the past and the history of the past and things that have worked, things that haven't. But if you're in if you want advice, please do go and seek a professional, and shares can go down as well as up, as we all know, I'm sure. So I'm Ed Croft, I'm CEO, co-founder here, and Megan, you are head of content.
I am.
Co-hosting too.
Yep.
So we'll be here answering your questions also at the end, and thanks for all the survey questions that came in, and I know that quite a few are being answered in the slides through the webinar. So do you want to run us through the agenda, Megan?
Yeah, so we'll just kick off with a little bit of an overview of that big question, why we're so reluctant to sell. It's certainly an issue that it certainly plagues me. I know it plagues quite a few of us who are here on the webinar today. So we're going to start by running through some of the theory behind that. We're then going to move on to a few more actionable points. So that all important point about how to take profit. So it's really interesting that selling a winning share is a very difficult thing to do. We've had a lot of questions about that. We're going to be splitting up the session into systematic approaches, which is where Ed specializes, and more discretionary approaches, which is where I tend to sit as an investor. But then also selling on market events, so takeovers, profit warnings, things like that. So really specific action on market events. Selling to the sleeping point, so managing the risk position, managing the role that a share plays in your portfolio. That can be a really interesting reason to sell a share or trim a share potentially. And then also the point about keeping losses small, something that I know a lot of us struggle with. Again, another thing that I really struggle with. So selling a losing share rather than just a winning share. So yeah, trying to cover as much as we can. So yeah, let's get started with that overall mindset piece. Why are we as investors so reluctant to sell?
Absolutely. So maybe do you want to sort of talk about some of your thoughts on why you're reluctant to sell, Megan, just to kick it off?
Yeah, and I must admit, I am very reluctant to sell. I have never sold a share, which is good that Ed's here, I guess, for everyone, because he's a bit more disciplined than I am. One of the reasons I have never sold a share, it does go back to that discretionary angle that I take with when I'm investing. I do an awful lot of research into the shares that I buy, and I do sometimes get a little bit over-attached. I'm sure some of you here who've been on previous webinars that I've presented will know how much I like Disney, Adobe, shares that I own, shares that I have grown attached to and have bought. And that sort of attachment bias, that unwillingness to see the negative side of shares that we own as investors, is a real problem. We also have, it's called confirmation bias. So looking for the factors, the traits of a share that we think are there. So we're very willing to see the positives in shares that we own. We're very willing to see the negatives in shares that we don't own. So that over attachment is a real problem for people, a real issue in the mindset of selling a share. We've also got some research. Ed, I'll hand over to you to look at some of the research that we've done.
Exactly, that we put our faith in gurus too much. And we have, thanks to Alex, who pulled this together yesterday for me. This chart shows the analyst recommendations. So we often call them broker recommendations in the UK, but also the sort of sponsored analysts who cover a lot of the small caps. This is the distribution of analyst recommendations across the London Stock Exchange as of, I think, 2 days ago. And you can see there's this huge bias towards buy and strong buy recommendations, and very, very little advice on when to sell, for a number of reasons. But, you very, very rarely have a CSL recommendation. And that's, when everyone is always talking their own book, or maybe there's a bit of media bias at play, there's PR at play, and we tend to find that everyone is always pitching the long case, the buy case for every share. And that makes it very hard to sell, because everyone is always, as you said, Megan, getting attached to the story, the narrative of the share, and believing in the Hollywood ending. So quite a key point there. Do you want to talk through the survey results?
Yeah, so this is quite interesting. This was some of you, I'm sure, will recognise this survey we sent out prior to the webinar around the real specific questions that we hope to address. And I think the results of this really lean into this problem around wanting to find the good in the shares that we own, because of those who answered the survey, the problem that most of you had, or the most prominent problem, was uncertainty around selling a winning stock. So not knowing when to sell shares that are doing well. And I think it's really interesting. It really speaks to the mindset there of how to, of the issues that people have, the psychological biases that people have when they're trying to make selling decisions. So we will be coming on to address that, and also the fear around selling and losing stock, which is the second most popular problem. We'll be addressing both of those things later.
And that feeds in actually to some of the something called the disposition effect, or Daniel Kahneman. If anyone ever read Thinking Fast and Slow, or perhaps bought it and put it on their shelf, like a lot of people did, there is this idea of prospect theory, which is essentially that we feel the pain of losses twice as much as the happiness of gains. And this leads to some quite interesting habits, because we tend to also not admit to ourselves that we've made a loss until we've sold. So we tend to hang on to our losers a bit too much. But also we tend to snatch at our winners too much, too frequently. And that leads to some quite dramatic results, actually. And there's been a study of something like 10,000 brokerage accounts, which showed that people have got a far higher likelihood to sell their winners than they do to sell their losers. So this shows the proportion of gains that are realized by investors across lots and lots of brokerage accounts against the losses realized. So we've got a tendency to sort of grab quick winners. And of course, we do let some run, which gets us very attached. But we're more likely to grab some quick gains than we are to actually crystallize our losses. So that'll be very useful information. We come back to looking at keeping losses small at the end of this presentation, and talk about stop losses and whether you should or you shouldn't. I know that can be quite a controversial topic. But this is a good quote. Selling your winners and holding your losers is like cutting the flowers and watering the weeds. You would not do that in your garden, so why would you do that in your portfolio? So bear that in mind. It's a great quote from Peter Lynch, who wrote One Up on Wall Street. It's just one of my, if you are a discretionary investor, I think that's the top pick, top recommendation for a book to buy. Got some book recommendations at the end of this. So we wanted to sort of kick this off with a quick discussion of how to take profits, or when maybe to sell those winning positions. And really this comes down to a lot of that uncertainty we all have, but it's made a lot easier And in fact, maybe potentially much, much easier if you know why you bought in the first place. Now, I've put this rather controversial statement on this slide saying selling is easy if you know why you've bought. And that is very true. And one of the big problems we have when we hang on to shares is we forget why we bought in the first place. So what I encourage everybody to do is to write down why you bought in the first place and what your thesis is. And Megan will talk a lot more about that in a while. But essentially, one of the things I'd like us to chat through is that selling is made a lot easier when you understand sort of some of the strategic considerations of the style of shares that you're buying. So asking yourself what type of share you're buying and what your strategy really leans to can really help with understanding your kind of selling timeframes and how to behave. So I've put here the quality, value, and momentum, which all very much underpins the investment philosophy of Stockopedia. It underpins the StockRanks and a lot of our kind of work. But each of these styles strategically lean towards slightly different benefits and slightly different sell theses. So maybe, Megan, you can kick this off on the quality side, and I'll talk a little bit more about the others.
Yeah. So, as you say, they're sort of looking at the overall strategy and why you're buying the shares in the first place is very important when you then are thinking about selling. So, looking at this quality chart here, you can see that the chart that Ed's put together here, hoping to buy before the share price starts to rise, and then selling, we've got a question mark there. We say a lot, followers of Warren Buffett, the ideal holding period is forever. Ideally we want to buy shares that we can hold forever, but obviously it's not always practical. Sometimes, as we'll go on to talk about later, sometimes the investment case can change. But from this quality angle, the benefit of holding shares over a longer period of time is that quality shares benefit more from compounding. So if we're looking at shares which have very, very high return on capital, return on capital employed, return on invested capital, there is a lot of that profit, the cash profits that are made as well, which can be reinvested back into the business. And that's where we see the real compounding effect come into play. And that's where we see multi-baggers emerge from, these really, really high quality companies that can keep reinvesting the profits from their operations and keep growing. So that's why that longer term time frame, that longer holding period is really beneficial for the quality companies, and why there is that question mark around the selling time period. Because yes, in an ideal world, hold it forever, but we will go on to talk about why that's not always the case.
Whereas actually, if you think about some other approaches, so value investing, people tend to buy value shares when they're cheap and maybe the valuation ratios are quite low, and they will benefit from that valuation ratio coming back to the average or the mean. That's a power called mean reversion. And so you'll generally find that value investors often buy too early, and they sell a bit early because they're trying to sell once it's got to the average valuation or a bit higher. So generally, it's a more dynamic strategy. You're looking to do that again and again and again and again, and to keep recycling back into cheap shares. Whereas momentum investing is more about potentially buying later. So actually a new trend has started, and often they will sell after the trend has already capped out. So there's a kind of a trend continuation, and they're trying to capture that part of the trend. But both of these sort of powers happen on this same sort of wave kind of theory. And so they're more dynamic approaches. So obviously there can be certain strategies that are in between these, but these are kind of more at the extremes. And so just bearing that in mind, because also some of these effects play out in different time frames. So Megan, you obviously mentioned that quality, the ideal holding period, is forever because of that compounding nature of reinvesting profits over the long term. But I've just put this holding period on a chart here, going from your buy point, 6 months, 1 year, 3 years, 5 years, and forever. And we laid out quality, value, and momentum. And I will talk through. We'll talk through each of these, but Megan, you obviously mentioned that quality stocks, the ideal time period is forever, but obviously not all quality stocks will stay high quality forever.
Yeah, no, absolutely, and I think that's probably explains here the difference in the holding period here. Like obviously 1 year to forever is quite a big variation. And there is a comment actually that we've already had. Warren Buffett does sell. I mean, yes, Warren Buffett does sell, and that's part of managing a healthy portfolio. But it is really then assessing for that continued quality. I think that's a really key point about whether that holding period should be forever. And again, it speaks to the whole problems around biases about hanging on for too long. Like, can you see diminishing quality? Do you convince yourself that the quality isn't diminishing? And I think that discipline is very, very important. But yes, if a company continues to be a quality company, we've got a couple of case studies of these potential buy and hold forever companies later. But looking to see, that continuation of the quality is very important. If it's not, then that's a signal to sell.
And because high profitability, high margins do attract competition. So sometimes, absolutely, and if you've got competitive advantage forever, fantastic. But sometimes it can be illusory. Yeah. So in putting this chart together, I think at the front end of these sort of black bars, the sort of weighted bold bars, as it were, are kind of more from the academic research. So the quality factor and the value factor, often 1 year holding periods, is quite well reviewed, whereas momentum tends to be a shorter term factor. So holding periods from 6 months to about 18 months, and really no longer than a couple of years you would want to hold a momentum stock. Whereas on value investing, it takes time for value to act, for that mean reversion of the valuation to come through. So often, even Ben Graham would often hold his deep value stocks for 2 or 3 years, but obviously that can be much longer, can take longer. So you can sort of see that there's an intersection point. And one thing what I find is that the 1 year holding period, if you find a high StockRank QVM share, 1 year holding period is very, very good. But a more contrarian share that you might be buying quality and a cheap stock when it's on the decline, you often need a longer holding period to really kind of benefit from those factors. So anyway, this is quite a useful guide for when to sell, because if you have a momentum stock, holding it too long can obviously be tricky. Whereas, the other factors you might want to hold for longer. So that's a kind of a useful frame, which just frames the when to sell consideration.
Yeah, absolutely. Just quickly to address a question that we've had from Steve from Southampton. He said I think it's an interesting point at this point. He's talking about the fact that he's made a lot of profit on one of the shares that he's bought. He's maxed out his ISA. He's made a lot of profit on Berkshire Hathaway. And his question is, should he keep it or reinvest it into stocks that, for him, it's providing dividends? And I think that really speaks to this point about thinking about what your strategy is there. Why are you holding Berkshire Hathaway? What's the purpose of it being in your portfolio? And if it is serving that purpose, then running your profits is the general sound advice from the industry. But if it's not providing the purpose that you put it in your portfolio for, then yes, maybe top slicing some of those profits and reinvesting into a stock that provides you with what you are looking for might be the right thing to do. So I think, coming back to the selling based on your overall strategy and what the purpose of that share is in your portfolio is interesting.
So for the next part of this presentation, what we're going to do is really, I've got this very, very simple model here, which is that on one side, you'll find certain investors are more systematic and more rules-based. And on the other extreme are more discretionary investors who are often more stock pickers. I lean more towards the rules-based and systematic and data-driven side. And I think Megan's more on the discretionary side. So we're going to take the lead slightly in this next parts of the presentation accordingly. But on the systematic side, really what you're often doing is buying when certain fundamental or technical criteria are fulfilled. That might be as simple as a very high stock rank, but it might be because of a stock screen or something like that. And then generally selling when either a holding period is met, like the ones we mentioned, maybe your 1 year holding period, or a threshold is met. So it might be a rank falls or a valuation goes to a certain level. So we'll talk about that in a little bit more depth in a moment. And Megan, on the discretionary side.
Yeah, so as I said before, sort of looking to buy when there's that sound investment thesis. So doing your research, doing your due diligence around the stock. And then the selling is really looking about when that investment thesis breaks. If you are looking at why you bought it in the first place, the same factors are no longer true. I think that it speaks to Ed's point earlier in the presentation about why it's quite important to write these things down. If you bought Berkshire Hathaway, let's say, for a certain reason, write it down. And then if the stock is no longer fulfilling that purpose, then that's a sign that the investment thesis is broken. But then that other point here on this slide is if there's a better opportunity that arises. And maybe that is because you have made an awful lot of profit on a stock and you want to use that, deploy that capital into another opportunity, into a different opportunity. Maybe it's because you personally need your investment portfolio to be doing something else. So having a look to see whether that investment opportunity is there and whether there is better opportunity. So those are the two real sort of discretionary selling criteria. We'll go on to those in more detail in a bit.
Okie dokie. So just on the systematic points, this is a huge topic, could be a webinar on its own. And I'm just going to very, very quickly hone in on two key points. One is time and one is thresholds. So these are really two of the simplest ways to make selling easy. So firstly, you could own for a targeted holding period. And again, that depends on your style. It could be 1 year, it could be 2 years. You know, if you're a momentum investor, it might be 6 months to a year. And you sell when that time threshold is over. So I'll talk about the NAPS portfolio in a moment. And that's a sort of a classic example of just using a 1 year holding period. And the other is to use a threshold. So it might be having a price target, a valuation target, or a ranking threshold. And when that's crossed, you immediately sell. And obviously that's, you know, stop losses we'll talk about later is a sort of a threshold that gets crossed, but it also might be a valuation threshold. So just honing in on each one of those very quickly. If you've read some of my work over the last, nearly 10 years now on the NAPS portfolio, this is a portfolio of sort of the top 20 highest ranked stocks across, 2 from each sector. And it's a 1 year holding period. And every single year it just rolls out, it sells the previous portfolio, buys the new portfolio, and that rolls on annually through time. And that's been a 13% annualized return. But it makes selling very, very, very simple. Sometimes you have the same candidate stocks in the next portfolio, or some of them, and obviously you adjust the position sizes back to equal weight. But it makes that selling decision very easy. And it means also, the reason I like it is because it means I'm less attached to my positions. And I run some family portfolios in exactly this way. And I find it's a very simple way. And you benefit from that tailwind of those quality, value, momentum drivers. So that's a very, very simple way to do it. And the other idea is through thresholds. And I've talked a bit about what I call the StockRank 90-70 rule, which is really leverages some third-party research by a chap called Christoph Reschenhofer. And essentially he showed that if you buy shares at a rank of 90 and above and sell them when they're 70 and below, you get there's a sort of a sweet spot there, which optimizes the returns. And this sort of principle is quite useful. And it doesn't always hold true because sometimes shares hold their high rank for a very long time and just sort of dawdle around. But in certain circumstances, it's worked very, very well for me as an overlay, as a threshold on top of some other rules. This is an example of Reach PLC that I put in my recent ebook on the StockRanks, which I bought personally and we bought in our investment club, and it at the 90 rank, and then sold when it crossed 70. And obviously that captured a huge sort of upswing in the returns. And the reason that the rank dropped is because the valuation got higher. And as that valuation got higher, it crossed a sort of a threshold. But you can obviously use just normal valuation ratios. Many value investors, like David Dremen, who's written some good books on investing, would buy very cheap stocks on low valuation ratios, like a low price earning or a low price to earnings peg ratio, and then sell them when they kind of get to the average or just above the average, and do it quite ruthlessly and systematically. And that is basically that sort of threshold principle taken to the portfolio level. So those systematic approaches. Now, you don't just have to be a systematic investor. Discretionary investors can benefit from these sort of rules because they can make some of those decisions easier. But we're now going to kind of push on and let Megan take the lead on the discretionary investors, sort of more thesis-driven investing. So,
yeah, just briefly before I look at that thesis-driven investing, just to talk about that point about the discretionary investors can use those systematic rules. We've run some research recently. Alex Namani ran this research which showed these different thresholds that can be used for value investors, really. And we're going to be publishing that research next week because it's really, really interesting. And I found it really, really interesting, especially around using these sort of threshold rules in sectors that are hard to understand, sectors that I normally don't touch, because as a discretionary investor, I like to know a lot about a stock before I buy it. So yeah, I'm really being sold on the rules, which is a relief, because it means that I can invest in more areas of the market, and maybe I'll sell eventually. But going on to this discretionary sort of area, so this slide talks about the work, as we mentioned before, from Peter Lynch in his book One Up on Wall Street, and it's this model that he put together of stocks that different categories of stocks that can do well. So we've sort of split them here into quality and into value. These are all different types, all different categories of stocks that you can invest in. So we've got fast growers, stalwart slow growers, turnaround cyclicals, and asset plays. And we've got a slide which we'll share in this presentation later, which you can drill into the sort of rules around this. But the general principle here is that when you are looking as a discretionary investor to pick a stock, you want to be acknowledging which of the categories you are buying this for. Are you buying a stalwart that you're looking to, I don't know, maybe take income from? Are you looking for a turnaround? Is it a contrarian play? Are you looking to buy a quality company at a low valuation? Or are you looking for a fast grower? And the important thing about identifying which of these categories your stock falls into is that you can then identify when that investment thesis changes. And that's very significant, because if there is a change, that can impact the share price. It can impact the momentum. If, for example, you have a fast growing stock which stops growing fast, you maybe the valuation might change. It might not justify such a high PE ratio. You see a big slump in the share price. So being able to sort of develop the investment thesis which really fits into one of these strategies is very important. We've got some case studies here to show you where selling can be the right thing to do because the strategy has changed. This is Fevertree. Hopefully this slide isn't too triggering for anyone who's still hanging on.
You had a question about Fevertree, didn't you?
Sorry?
You had a question about Fevertree, didn't you?
Yeah. We actually, I've seen a few questions about Fevertree in the last sort of few weeks. So a few people who seem to be sort of wondering what to do because they're still hanging on, having maybe bought nearer the beginning. So obviously Fevertree came to the market in 2015, loads of potential, loads of exciting growth, and we can see when it joined the market, it was a fast grower. We can see here from the sales compound annual growth rate, 40 to 50 odd %, but more importantly, the EPS growth rate was double digit figures. I mean, triple digit figures in its first year of after IPO, but really significant profit growth year on year. Also significantly, this isn't shown here, but you can see it if you look back over the historic stock reports on our website. You can see that it was hitting its earnings expectations every single year, often beating them. This changed in 2018, 2019. The growth rate slowed. So 2019 was the first year. So FY 2019 was the first year where EPS growth slowed to 15%. Following year was at 3%. But also, more importantly, these were below earnings expectations at the time. So from that period, so from 2018 to 2019, Fevertree changed from being a fast growing stock to a slow growing stock. Now, if you were holding Fevertree in that time, it's quite a difficult one. It's quite a challenging one to make a decision on because it's still an incredibly high quality stock. It's an incredibly high quality business. The product is obviously fantastic. It's all over the place. There is a lot of good to still be said about Fevertree as a company, but its growth rate no longer justifies a PE ratio of what it was when it listed. I think when we looked back at one of the historic stock reports, it was 60 plus times forecast earnings in 2018. That's not justified by the growth rate, the EPS growth rate now. It was questionably justified maybe when the EPS was growing at 30 odd % a year, but it's no longer growing at that rate. So anyone who's still hanging on and questioning what's happened there, it's still such a high quality company. That is the answer. And really the selling strategy around Fevertree should have been, once that style of investing changed from fast growth to slow growth. And yes, you'd have maybe been a bit depressed at having to sell after that big drop off in 2018, but probably a lot less depressed than you would be now. And maybe now would be a buying opportunity to buy into a slower grower. But yeah, for anyone still hanging on to what they hoped was going to be a fast grower again, I'm not so sure that it's coming back as a fast grower.
It's such a classic kind of story, this, because I've seen it again and again and again. You have your Asoses or companies like that have this amazing growth phase, and then they turn, and in our style classification they're called high flyers, and then they turn, and high flyers tend to be very high quality, high momentum, but very expensive. So that P of 65, often when that you see that flashes, especially in UK stocks, often a red flag. In America it seems to be more normal, but like here it's a big red flag, because as soon as they miss expectations, as you said, they can plummet quite hard, and they turn into what we call falling stars. So high quality stocks, but where the momentum's down and the valuation's very high. There was a great quote, I think it's the next slide, by Jim Slater in his book. You want to be first in the line of disappointed enthusiasts, and I love that quote from him because it sort of says a lot. And as you said, like, understanding that thesis and the investor basic that investing based on that thesis, when that thesis turns, it can change the entire shareholder base and lead to a lot of opportunity cost as it sort of churns away. You've got some more case studies here, don't you?
Yeah, so this is actually a case study of where the investment thesis potentially can change for the better. And interestingly, we've had a question on YouTube from Claudine. She's asked what happens when a quality stock becomes a momentum stock, e.g. ASML, LVMH, Novo Nordisk, NVIDIA. I've picked an example of a company, because we had a question about Microsoft specifically, which came in earlier. And I think this is a classic example of a company which, I mean, it's a 50, 60-year-old company. It's been listed for a very long time. It is a stalwart of the tech industry. It certainly was. It has become an incredibly fast grower. In the last sort of 10 years, maybe slightly less than that, 8 to 10 years, the company has invested a lot in the cloud, more recently in AI. And because of that, the sort of earnings growth has just been phenomenal. I mean, the figures that we're showing here, 30 odd % on a constant basis, double-digit earnings growth. And I think we've seen that with quite a few of the stocks in the US. The fact that these very large stalwarts of their industry have turned into fast-growing companies. And I mean, Ben Chalmers just put a comment about broker upgrades and downgrades. I think this is actually a very good case study about a company which keeps beating earnings expectations, therefore keeps getting upgraded. And the cycle just continues and continues. It's one of those, it's a classic example of a quality compounder, which has turned into a really, really fast grower because it's been able to reinvest the profits that it's made into innovation.
It's a really important point. And this is, I guess this slide is more about when not to sell. And what you said, and I think what Ben mentioned about when estimates are being upgraded, one of the times when people snatch at profits, and I've actually forgot to put it on a slide here, but there are examples. I remember there was a Dark Group many years ago. I have a case study of that beating expectations, and one on the same week or day profit warning, and then what happened to the two share prices. But the key point is that you should not sell when something announces that it's ahead of expectations. It's such an important factor. And so there are two things going on here. One is when they're beating expectations, keep holding. And when not to sell is when a category changes even for the better. So the thesis may be changing from stalwart into that fast grower phase. And that's adjusting your expectations to change that classification into a different type. Of course, if it gets too far ahead of itself on a really high P ratio, well, we saw what happened with Fever Tree. So you've got to be kind of keep your wits about you, and keep an eye on the changing dynamics of these shares. You've got another one here, don't you, Megan?
Yeah, so this one is more of a question mark, I guess. This is again, had a question about this beforehand. I would argue that in the UK there are very, very few companies that have made that transition from stalwart to fast grower. I think we've seen a few, like the Fever Trees, which have not been able to maintain their fast growing position and have turned into stalwarts or slower growers. Relics is potentially an exception to the ability of companies in the UK to turn from stalwarts into fast growers. This is a company, again, been around for a very long time, but it has a very, very large exposure to elements of the tech industry which are really flying, especially AI. So RELX is a big data business. So it has a lot of data which is feeding the sort of educational elements around the use of AI. And I think there's a really interesting discretionary angle around RELX, which is an incredibly high quality company. And we are seeing that with the earnings results. So 2022, 2023, the company sort of transitioned from quite solid high single digit earnings growth figures to double digit earnings growth figures. And if that can continue, I think RELX could potentially be a fast grower. But one thing that's really important to note here, and I think that's hopefully going to address some of the questions I can see that are coming up, like the problem is when to know, knowing when it is just a short-term decline or a long-term. How do you know the difference between a Fevertree and a Microsoft? I think it really comes back to making sure your expectations and your thesis are correct. So with RELX, as an example, if you were holding it as a stalwart, probably being accepting of the fact that the growth wasn't particularly spectacular was the right thing to do. Holding it in your portfolio just to keep it, I mean, it pays a dividend, just to keep churning away, churning away that dividend, small growth year on year, a high quality company in your portfolio. If you are now holding it because it's growing fast, you need to change that thesis. You need to write down that change, because if then it stops being a fast grower and it goes back to being a stalwart, we might see a decline in the share price of RELX. It won't quite justify the kind of PE ratio or kind of valuation that it's currently holding. The same is true of Microsoft. So I hope that addresses the question of how do you know when that moment comes. I think as a discretionary investor, it's really trying to be honest about the fact that what is the company actually reporting? And I think with Fevertree and ASOS and Boohoo and the companies that's happened to before, I know obviously hindsight is a lot easier than what's happening at the time, but we can see that those earnings figures were just they weren't up to the same level that they were at before. The market was getting more crowded. There was more competition. The compounding factors, the compounding nature of the business had stopped. So the investment thesis had changed. So I think that's a really important point. Writing down the investment thesis and writing down when it's changed so you can set your expectations right is the right thing to do.
Cool. Okay. So moving on. So that's kind of a lightning tour of, we've only got limited time of systematic and discretionary considerations. And I think, I definitely back up that. If you're a discretionary investor, you've got to write down your thesis. You want to definitely kind of think about and read some good books. We've got some good book tips at the end of this presentation, which I think will be very helpful in developing that thesis and testing it with the community and so on. So anyway, I want to talk about selling due to some market events. Because we've got our own research on this and there's lots of third-party research. I'm just going to highlight a couple of them. So firstly, you're going to see some situations such as profit warnings, accounting irregularities, and takeover bids, which takeover bids seem to happen a lot in the UK at the moment, but profit warnings are always rife. We've done a lot of research on profit warnings, so I'll just skip over this, but very, very quickly, the idea is sell immediately on a profit warning. That's the kind of rule of thumb, and I'll explain why in a moment. If there are accounting irregularities, we haven't done the research ourselves, but I've got third-party research which shows that there's generally that first-day slump, just like a profit warning, but then a continued 1 to 3 year underperform. You often see that things like finance director changes, accounting changes, et cetera, they have a little bit of inner turmoil while they sort that out, and any of the kind of operational issues that might have led to the accounting irregularities, and it's never a good sign. And the other one is a takeover bid. And obviously takeover bids, you see the first-day jump. And generally, most of the gain for a takeover bid happens on that first bid. But obviously, there can be more counter bids or higher bids from the same company. But sometimes there can also be a risk of failure when it can drop. So you have to sort of, a rule of thumb that I know quite a few private investors use is to sell half on a bid, which can be very hard to do because the companies that get bid for can sometimes be your favorite stocks. They can sometimes be great little growth stocks. They can be great little companies. And you're like, why are they getting taken private? It's so annoying. But generally, in all these situations, there is what we will call an opportunity cost to holding the shares. So the opportunity cost of holding a profit warning or an accounting irregularity means that actually the time that it takes for it to recover, the capital could be better deployed somewhere else. And similarly on a bid, often the gains are actually quite limited as it just sort of grows slowly to where the bid that's been accepted, because it can take up to a year to complete a deal. So that's an important consideration. I just want to talk through the profit warning research that we did, and you can find this in the Academy. Our research of 245 small cap profit warnings that were all covered in our smaller companies reporting, we found that the average first day decline was about 24%. But then we saw over the next 18 months continued declines on average. So especially in the first 6 months, but even after that, for the next year, the shares on average went nowhere. And so if you ever want to know what to do on a profit warning, I will always say the best rule of thumb is just cut your loss, sell, it hurts like hell, but redeploy the capital. This little gray line shows what, on average, what the FTSE All Share would have done in the same period. So even just selling the position and investing it on average into an index actually would have done better than just hanging on to the shares. So it's kind of a key insight, except in one situation. Megan, what's the one situation where you might want to hang on after a profit warning?
Well, if the share is a very high quality share and the profit warning doesn't diminish that quality. So I think an example of this was when ASOS's factory burnt down, when the Hemel Hempstead Buncefield oil depot exploded. Obviously, massive profit warning came after that event, but it ended up being a buying opportunity. It was a quality company in a fast-growing industry, and it was able to recover, and anyone who invested after that event massively profited. So if it is an isolated event that can really be isolated to a one-off occurrence, and everything other than that is a high quality company, and we can see it with our quality rank here. This research shows that it's sort of around the 75 mark quality rank, that is sort of is high enough quality to do well, to not see that continued slump after a profit warning, and potentially can see a profit warning as a buying opportunity. But yeah, it is a tricky one, because obviously a lot of the research does show that, and the research that we've done does show that sort of cutting your losses immediately and not sort of sitting on it as it continues to fall is sensible. And
often profit warnings are serial, so sometimes you get another one and even another one after that, which is problematic. So sometimes, yes, can be dead money. But yeah, the scatter plot, which got the quality rank on the bottom axis, does show that certainly the ones that recovered the most were always likely to be the higher quality stocks. So yeah, always worth bearing in mind.
Yeah, and we've got a case study here. This specific question that came in before the webinar about Vistry, the house builder, which is a high quality stock. It's currently got a quality rank of 70. But so sort of on the verge of is it high enough quality? Profit warning last week. The company found some accounting anomalies. 29% share price drop on the day. This one for me sort of highlights two red flags: both the profit warning and the accounting anomalies problem. They've isolated the accounting anomalies into one division, but accounting anomalies is another thing that doesn't tend to come as an isolated thing. So arguably, maybe this isn't as high a quality company as it maybe had pitched itself to be. But I think this is an interesting example of, obviously, that 29% share price drop on the day was pretty painful. And maybe there's a few people who are tempted to sort of take a little bit of a bite. For me, this wouldn't be one that quite falls into that high enough quality camp.
It's so difficult, isn't it? Because, if you're in the discretionary stock pickers world, in the back of your mind is, the Labour government are going to build, and you think house builders, there's a tailwind behind the sector, and it's all made very, very complicated. So it's very, very difficult to make those decisions as a discretionary investor. That's why I like rules of thumb. They're very, very sort of, black and white. You can, make a decision based on them. You got another case study here.
Yes, I do. And this one's a takeover case study. So I think the advice, the sort of suggestion of selling half on the first announcement of takeover is really, really quite an interesting one. This is TI Fluid Systems. Again, question came in before the webinar. It's had 4 takeover offers now, varying between 165p and 195p. Share price currently slightly below that most recent takeover offer at 180p, and management is saying it will accept a bid at around 200p. Now, for me, so the first sort of offer came in at the start of September, and first offer, and then sort of slight slump, and then another jump again after the second offer. And I think that that rule of thumb of selling half after the first one, taking a little bit of profits there, selling half again after the second one, taking a little bit of profits there, and then maybe waiting for the rest of it. I think that seems pretty sensible with TI Fluid Systems. If you were to zoom out on this share price chart, I think there'll be a lot of people who are very disappointed. This is a classic example of a company that's really got lost in the sell-off in the UK in recent years, and clearly there is a buyer who wants to take advantage of that. I personally had a situation like that a few years ago with Shaftesbury. I was convinced it was going to be a COVID bounce back. I was sure that the property market in London was going to soar again, and Shaftesbury was going to be brilliant. Shaftesbury got taken over, and I never recouped the losses that I made on that share. I just waited until I received the cash, which was a mistake. I should have sold when the takeover was announced, because by the time you sit and wait, that is an opportunity cost. That is an opportunity that I could have redeployed that capital into other opportunities around that time. But I was just sitting and waiting for the cash to appear in my brokerage account, and it wasn't the right thing to do. I didn't make much of a gain. So yeah, taking the half seems like a very sensible strategy, and I would say that TI Fluid Systems looks like a sensible one to deploy that strategy in.
Yeah, absolutely. You can see that jump up to about 170 there, and it's at 180 now. I mean, okay, it's only a month and a half later, and but this is one of those situations where it's got higher and higher bids, and Domino's Pizza EU was one of those earlier in the year, which actually got a few bids from the same bidder, which kept trying to bid up and buy more of the other shareholders' stock. So, counter bids and extra bids do come through, but often they can, bids can be withdrawn or rejected. So it's sometimes can go either way. Anyways, on next. So there's been a couple of questions on this point. One of them was from, I think, Alpha Bartlett. With very profitable shares, is there a place for selling enough to realize your initial stake, so releasing capital for other investments and removing the fear of possibly losing your initial investment? I think it's a very good question, and this is really one. I know, Megan, you put some slides together here, so do you want to carry on?
Yes. So this is sort of this is a model portfolio. This is not something that's real. So it's a portfolio I wish I'd put together in 2015, but it's really just to sort of try and characterize this point about where it is potentially the right thing to do to sort of slice your shares away. So this model portfolio of high quality shares in 2015, high quality growing shares, the kind of stocks that I like to invest in, put £2,000 into 10 stocks, so 20,000 in total. I invested my whole ISA, so 10% in each. So it was an equally weighted portfolio at inception. Now, assuming I am a high quality investor, a buy and hold forever, I haven't made any changes. Probably not completely realistic, but this is just to demonstrate a point. That now this is not an equally weighted portfolio. So you can see here that Games Workshop is now 33% of my portfolio. I quite like this as an example, because this portfolio also has Apple and Microsoft in, but Games Workshop is the one that's really shone in the last eight-ish years, and is now 33% of my portfolio. So I would argue that is slightly too much weighting in Games Workshop. It's a fantastic company. It continues to be a fantastic company. I continue to be happy to hold it. But if something bad happens at Games Workshop, if there is that one-off big dip from a freak profit warning, if something happens that's outside of control, if there's any big sell-off, that's going to have a really big impact on my overall portfolio returns. What you can also see here on the right-hand side is the asset allocation as a whole across different sectors. So about half of my portfolio is in the consumer cyclicals industry, but most of that comes from Games Workshop. So although it looks like I'm quite nicely balanced across sensitives and cyclicals, I'm not really, because most of my exposure in the cyclicals area comes from one stock. Again, I don't have an awful lot of exposure to the defensive space. It's a tiny little portion of defensives in my portfolio. So it is not a very well weighted portfolio because stocks have moved. They've moved at different rates. So this is an example of maybe where it might be worth slicing a little bit of my Games Workshop and reinvesting into other opportunities, preserving the initial investment, but redeploying it elsewhere.
Yeah, and I would just back that up. Like we did a huge amount of content on multi-baggers towards the end of last year, which are shares which go and double, triple, quadruple, and 10 bag, and Games Workshop was one of those. And what we actually found is that on the journey of multi-bagging, the average decline, including the pandemic, was 62% in any of those shares. But before the pandemic, it was 43%. So if you can imagine that position of 33% in that portfolio being cut by 60%, that's 15, 16, 17% of your portfolio. And on the next slide, I won't cover it in much detail, but this just shows as the position in the blue lines on the multi-bagging of a 10% position size, it starts to dominate that portfolio. If it 10 bags and all the others stay the same size, it becomes more than half the portfolio. And a drawdown of 40% or so would actually be a drawdown on your portfolio of 25% or so. So you know, there is a saying that, you know, you got good wine in a good case, and it's, you know, maturing away and it's rising in value. It's okay to have a sip now and then. So taking part profits in positions just to manage your portfolio risk actually is quite a sensible thing to do. You don't have to sell the whole share, right? If it's going well for you, but you are a little bit uncomfortable, they say sell to the sleeping point, which will be different for everybody. You want to feel slightly uncomfortable sometimes with your position sizes, but sell to the sleeping point. It's a very good thing to do. So there we go. Now, listen here. Now we're going to close this presentation with a little bit about keeping losses small, which is a very controversial topic. And I wrote a piece on this some time ago, which drew a lot of comments because I think the vast majority of people don't cut their losers. And like I said earlier, we're sort of predisposed not to cut our losers. And this chart, actually, there's a great book, which I do recommend everyone on this webinar read. We don't get any commission. This is just actually a really good book. It's called The Art of Execution by Lee Freeman Shaw. We'll send these slides to you all so that you've all got a copy. But essentially, he said that when share prices decline from the purchase price, there are three types of behaviors. And he's got a wonderful little analogy. He says people either behave like the rabbit, the assassin, or the hunter. And the rabbit, like the proverbial rabbit in the headlights, does nothing, freezes when the price drops and avoids making a decision. And actually, they tended to be the investors who lost. So Freeman Shaw, he actually he had lots and lots of fund managers that he worked with, and he analyzed all of their successes or losses. And he found out that the ones who tended to lose had this behavior of being rabbits. The winning behaviors were either being an assassin who cuts the positions immediately on a significant loss. In other words, uses a stop loss and just cuts and redeploys the capital somewhere else. Or is a hunter, and the hunter would be someone who does a lot more analysis. But if there's a drop, they reconfirm the analysis and they will average down. Now, I am definitely an assassin. I don't like losses. So I do use stop losses quite considerably in my personal account. And I do that, and I've got a couple of tips on doing that in a moment. But Megan, I would imagine you're much more of a hunter.
Yeah, I mean, unfortunately, I think I'd probably admit I was a rabbit, but I would like to be a hunter. I think I definitely am more inclined towards that. And we had a question actually from someone specifically asking about IG design before the webinar, and I think this is a really good example of where this sort of knowledge can come into play. So the question is really about the fact that IG design has not done very well recently. It's been quite a disappointing share, but the person who was asking the question said that they really know the company really, really well. They like it. They've done their due diligence. They've spent a lot of time knowing what's going on at IG design, in which case be a hunter. I think the right thing to do there, if you're still convinced that the investment case stands, is to average down, is to take advantage of that lower share price. But yes, as you say, Ed, I think the assassin sort of mindset is very sensible for being able to keep those losses as small as possible.
One of the reasons I advocate it also for private investors is, not many of us are full-time investors. And if you're full-time and you really have studied company analysis and you really do know your stuff, I think the people that do know their stuff super well should act like the hunter. Mm-hmm. But if you're someone who hasn't done as much research on the shares and you are unsure, I think being an assassin is a much more important thing to do. It's protecting your starting capital is so important, and bear markets do happen. And I've seen too many people invest all their portfolio at the top of bull markets and then get really, really hurt. And I think capital protection is really key. Now, a couple of people were saying what level to set the stop at. And just to sort of double down on this point, this is a chart that shows the asymmetry of loss. So if you imagine you've got a 10% loss, you only need an 11% gain to recover the loss. But if you have a 50% loss, if you've let that loss grow, you need 100%. You need it to double to get back to even. And that's huge. And God forbid, if you lose 90%, you need 900% to get back to even. So you want to try and keep those losses small. It's really important. But the trouble with small caps is they're really volatile. So if you set a 10% stop loss and everything, I guarantee you'll keep being stopped out just on natural volatility, which is really bad. You don't want to do that. So I always advocate using what I would call a volatility-based stop. I'm just skipping forward a couple of slides. And I've shown this chart a few times. The risk ratings that we publish at the top of all stock reports are a guide to the volatility of the share. And generally this chart, which you'll receive the slides, but it shows you that if you've got a kind of adventurous share in the middle, that's kind of got an average volatility of
30-45%,
which is pretty typical for shares. They're really volatile over a 1 year time period. And setting a stop loss level at about half that it means that you've kind of got enough wiggle room. But if you're in really speculative shares, which have got very high volatility, you're still going to get stopped out there. Personally, I don't like letting a stop happen. I don't like losing more than 20% on a share. I'm normally edging out at 10%, 15% losses because I do try and time some entries. When I'm not using a pure sort of NAPS approach, I've got my own personal portfolio that I do take a bit more kind of more of an active approach with. So I think that's quite important. Some people will just use volatility stops. Some people will also set stops at more technical levels where the recent support line for the share is. We don't have time to cover the technical analysis in this webinar, but there's a lot of ways that you can do this. So I would say don't just use one hard and fast, let's say 10% rule, because you'll find it gets triggered too much. But do try and cap those losses. It's just a good behavior. Now, we are just up. Do you want to say anything on this point? Because we are almost up. I was just going to say,
hopefully these rules of thumbs will be helpful for the 39% of you who identify as rabbits based on the poll that we sent out. So like me, hopefully we can have a bit more assassin behavior that will help with that.
Absolutely. I mean, I do think it is one of those things. Just to reiterate, declining markets are tough. When markets decline, I like to reduce my equity exposure in downtrending markets, and actually using things like sell rules actually means that you are basically raising capital. And you think that whole 2-year bear market from, 2021 down to the bottom at the end of 23. We saw so many shares fall up to sort of 40-50% or more. And if you were raising capital through that period, you're a much better place for when the turn came in. Selling is important. It really is important.
Yeah. And I guess that's the sort of making those decisions. I think hopefully acknowledging that you're a rabbit and wanting to move towards either being an assassin or a hunter can help, hopefully. Knowing that stop losses can help you become more of an assassin, setting really hard and fast rules. Or if you do decide you're a hunter, then making sure that you're ready to take advantage of share price falls and average down if you so want to. And I will definitely be trying to carry that forward. Also thinking about the amount of time that you have. I mean, one of the reasons that I'm a rabbit is because I don't actually have a lot of time to spend doing my investing. So maybe setting stop losses would be the right thing for me to do. So yeah, thinking about your whole investment strategy is important.
I'm definitely an average up guy. Anyways, right, we just kind of put a summary slide together as we sort of cap this off. We'll go to some Q&A. Megan, do you want to take the top row?
Yeah, so these three sort of overall principles, I guess the first one, which we haven't touched on here because it's very much a personal finance question. If you need the money, obviously most people have money in investment. Some people have money in investment for certain specific reasons. If you need it, then obviously that is a reason to sell. The second and the third points here are really about the two systems, so the systematic or the discretionary situation. So if you're a systematic investor, if your target is met, if your thresholds are met, then that's a reason to sell. And if you're a discretionary investor, if the thesis is now invalid, if the investment case that you bought into no longer stacks up, then there's your selling criteria hit.
And just to carry on, the fourth point is opportunity cost. So we talked about market events like profit warnings, accounting irregularities, or even takeover bids, but also just the opportunity cost of holding on to a current position when actually there's a much better opportunity for that position. If you do find a much better position, then why not swap it out? Position risk. Megan covered, kind of taking profits on potentially positions as they get to become too large a part of your portfolio and therefore too risky for your tolerance, sell to the sleeping point. And also the key point of stop losses, selling to protect capital or just to admit you've made a mistake. You could say that Warren Buffett used a kind of a stop loss on Tesco. I think he might have made a gain on it, but anyway, he decided it was a mistake and he got rid of it. So really that's it. We do have a couple of, just on this last slide, some good books which have got some good tips on buying and selling, really, that we've just shared here. There's lots of others, but there's some quite useful points in some of those books. We covered some of them in this presentation. It's a big topic, and we could probably do 3 or 4 webinars on this. Okay, so do we want to cover any questions in particular before we sign out?
I feel like we've gone through quite a lot of them as we're going on, and I can't see any others that massively leap out to me, apart from ones that are more specific around political events. And I wonder whether it might be that we want to say that we'll look at some of those in a follow-up webinar. We've got plenty of slots available. I think these are big topics. I think they're really interesting. So we've got 2 big political events coming up at the end of this month. We've got the budget, and we've got the US elections. So I think, those specific sort of wider market events is sort of a whole topic here that we haven't covered. I would say the general situation is stick with what you're investing for. I think if you, obviously markets can do funny things. They can make it difficult to be an investor, but trying to shut out the noise and think about your rules and think about why you're an investor is important when there's a lot of turbulence going on. But yeah, potentially trying to address those in either some follow-up articles or in a future webinar might be something that we can do. Is there anything that leaps out to you?
No, I think there are, somebody was saying, do I use automatic stop losses? I personally don't, because I think they get taken advantage of, especially if you're spread betting. I find if you set a sort of guaranteed stop, they just get triggered, and I've never liked using them. And so I always just keep an eye on things. And I don't like seeing any red in my portfolio. I'll be totally honest. I just don't like seeing any red. I like all positions to show gains. So as soon as and I've trained myself over many years. In fact, you mentioned Assos's fire, and which was way back, I think probably like 2004, 2005. Yeah. I had 2 companies I was assessing, and I didn't buy Assos, and I bought Maduro Resources, and that dropped 90%. And Assos, I think, went up 100 bags. So I learned my lesson there. And I didn't, if I'd used a stop loss on Maduro Resources and switched into Assos, I'd have done rather better. Would I have sold at the top? Well, I don't know, but probably, because the thesis would have changed, right?
Well, yeah, absolutely. Because, the thesis changes at the top or near the top. Question specifically about our StockRank styles. So we talked earlier about the styles of from One Up on Wall Street, the styles on One Up on Wall Street. Our StockRank styles are largely based on the book, on the One Up on Wall Street book. Question here specifically about should we sell momentum traps? It's not a hard and fast rule, but momentum traps are certainly one of our losing styles. But again, looking, I think the key element here is that change in a style. So we have winning styles, and even if a winning style changes to another winning style, that might also be a trigger for selling. But yes, a momentum trap is a losing style. So
yeah, I mean, momentum traps, and if anybody doesn't understand what the styles are, hopefully, Lawrence, if there's anything in the academy that you can share a link to, that would be great. But we do show this this style here, and it's based on the fingerprint of the StockRanks quality value momentum rank. And a momentum trap will have very high momentum. So that you can see here, funding circle has got very strong momentum, 98, but low quality and expensive, so low value. And actually, we find momentum traps actually one of the better performers of the losing styles, and which is surprising. But often you can see some very ramped shares that, you know, often the quality doesn't come through. You'd rather actually look at winning style shares, which and one of the kind of the very common transitions we see are high flyers, which is a very, very high performing type of style, which are really the growth stocks. And I mean, actually, so here's a classic one, Marks and Spencer, which has been an amazing performer for the community as a whole. It's had a very high stock rank for almost this entire journey. It jumped up to a 99 rank early 23, and it's absolutely powered through. Now, what happens is that sometimes those very high flyer has got high quality, high momentum, but it's expensive. And those high flyers, if they do miss expectations, they turn into falling stars. So the momentum reverses and they become a high quality stock, which is on a downtrend. And that's a painful place to be. I'm not sure if Fever Tree still has the falling star classification, but yes, it does. So this is a good example of one that would have been a high flyer, but then when it misses expectations, it becomes a falling star. So these are really useful. I think the one transition I would always be so careful on is high flyer to falling star, because that valuation difference is really big. And
yeah, no, really interesting. And this is all of these sort of our own styles and our ranks, and sort of trying to build some rules around that can be really, really helpful. And we'll be publishing some research, so keep your eye on that. And if you have any specific areas that you'd like for us to delve into any more detail on future webinars, do let us know, because we love doing them. We've now got our brand new events page, which allows us to deliver even more webinars. We've got one already booked in for the 30th of October. So if you've got any specific questions that you'd like us to, any specific topics that you'd like us to cover in that webinar, even if it's a follow-on from this one, please do let us know, because we're now well over an hour, and I feel like it's time to call it. What do you think, Ed?
Well, yeah, I agree. I wanted to say thanks to everybody. There's some nice compliments there, Michael. Very, very nice of you to say so. Thanks very much, everyone, for attending and staying and listening to us as we rattle on this kind of controversial topic, which has got so many angles to it. We've covered a lot of territory, and hopefully it's been useful. I'm sure we could have gone on for another hour, but I don't think everyone would have stayed. So thanks very much, everybody. Cheers, Megan. And I hope everyone, it might be supper time for everyone. So please enjoy, and we'll see you again soon.
Thanks.